Dividend yield is a hot topic in investing. Before you invest in high dividend yield stocks, it is important to understand the dividend yield formula, but also to have an idea of the risks of only looking at dividend yield. How to calculate and use dividend yield. Watch the whole video to see both the pros and the cons of dividend yield. Examples of industries where dividend traditionally has been high are oil, commercial real estate and telecom. In the current low interest rate environment, you make very little return putting your money in a savings account or treasury bonds. That's why many investors turn to high dividend industries with relatively low share price volatility to invest. A cash dividend is a cash payment from a company to its shareholders. Let's look at the dividend for two companies in the telecom industry, AT&T and Verizon. If you go to the investor relations websites of these companies, you will see an overview of the historical dividends that they have been paying. In the case of AT&T, the current quarterly dividend in the spring of 2017 is 49 cents per quarter. 49 cents per quarter equals $1.96 per year, assuming the dividend level stays unchanged. For Verizon, the current quarterly dividend is 57.75 cents per quarter, which translates to $2.31 per year. So is Verizon a more attractive investment as they pay a higher absolute amount of dividend? To answer that question, one of the things you could do is to make a relative comparison. In order to start receiving dividends, you will have to buy shares in that company. How attractive is the dividend compared to the share price? The formula for dividend yield is annual dividend divided by the share price. Let's make that calculation for both AT&T and Verizon. AT&T has an annual dividend of $1.96 and a closing share price per April 5th, 2017 of $41.02. AT&T's dividend yield is therefore 4.8%. Verizon has an annual dividend of $2.31 and a closing share price per April 5th, 2017 of $48.44. Verizon dividend yield is therefore also 4.8%. So in this case, dividend yield is not going to help you distinguish whether you should invest in AT&T or Verizon. Familiarize yourself with the company's strategic direction and ambition, as well as its financial performance. Review the latest annual report in detail, including its letter to the shareholders, which I think is a great start to learn more about the company. Maybe you should invest in both companies, as 4.8% dividend yield sounds attractive. Or alternatively, stay away from telecom altogether if you are not excited about its prospects. What are some of the pitfalls of using dividend yield as one of the main criteria for making investment decisions? You might not be seeing the whole picture. Here are 5 things you must be aware of. Strategic risk. I bet that companies producing horse-drawn carriages were doing very well in the 1880s, generating lots of profit and cash and paying hefty dividends. Unfortunately, the product was at the end of its life cycle and would soon be superseded. Ask yourself this question: at what stage of its life cycle is the company that you are looking to invest in? Cash flow. If cash balance is the water level in the bathtub, then cash flow is the water flowing in and the water flowing out. Is the company that you are looking to invest in generating enough cash from operating activities to be able to pay dividends? Or are they having to sell business units or increase debt? Learn how to read a cash flow statement in the Finance Storyteller video that I will link to. The turkey problem. A turkey or chicken that has been fed every single day for 1,000 days and has extrapolated that to a very bright future ahead will be very surprised to have its head chopped off on the next day. The same can apply to stocks. I have heard the CEO of a very large global company say that the dividend is secure, only to renege on that promise shortly thereafter by having to cut the dividend by 2/3. Neither the dividend nor the share price has recovered since then. I have been waiting almost 10 years. Payout versus invest. Why is a company paying such a high dividend? Are they financially healthy and want to reward shareholders by paying out dividends? Or have they run out of ideas of how to invest money in R&D or acquisitions? What is the best place for the cash? In the pockets of investors by paying dividends, or in exciting growth projects inside the company that promise larger dividends in the future. Lastly, math is just math. Dividend yield is the annual dividend divided by the share price. Today's dividend might be $4 and today's share price $100, hence the dividend yield is 4%. If the company continues to do well and generates lots of profit and cash flow, tomorrow's dividend might be $8. If investors are very excited about the company's strategy and financial performance, the share price could have increased to $200. The dividend yield is still 4%, but I am very happy as I could sell the share today for double the amount I bought it for. The opposite might also be true. The company's profit and cash flow performance has deteriorated. The dividend has been cut to $2, and as investors are less excited about the company's strategy and financial performance, the share price could have decreased to $50. The dividend yield is still 4%, but I am very sad as I can sell the share today for only half of the amount I bought it for. In summary, use dividend yield where appropriate, but look at the broader context before investing in the stock market. Thank you for watching. If you enjoyed this discussion of how to calculate and interpret dividend yield, then please press the like button for me and share the video with friends and colleagues. On this end screen, there are a few suggestions of videos you can watch next. Please subscribe to the Finance Storyteller channel so you can stay up to date on my latest videos for free. Thank you.